Yeah. So hello. Again, like resuming this session on the currency derivatives segment, which is briefed by the NISM course. So we already touched about the framework, the various segment, the ecosystem or the constituents of or the components of the exchange of the platform as such. But apart from this, what constitutes the service is the main focus, or is where the entire I mean entire service or entire financial market gets involved. So one of the computation that gets involved for the service provided by the trade brokers is the derivatives, currency derivatives, future pricing. So the future price of the currency, of the base currency, can be determined if the interest rate is known. So the spot price, that is the for example, for the pair USD INR, the spot would be the INR, which would be 83, and that 83 uh, when multiplied by the the interest rate, that is 1 plus the risk free rate, which is mostly for Indian denomination, it's 7%. So 83 times 1 plus 7% equals the future price into the future, that is the base currency's risk free rate. Usually the base currency's risk free rate would be low, as it's from a better economy. So it would be 1.5%. So in nutshell, if the formula is reduced, so the derivation or the future price of USD becomes spot price plus the risk free rate of Indian currency, or the spot minus the risk free rate of the base currency, times the period. Why period gets involved? Period, adding period as a multiple adds more accuracy to the number, as not necessarily all the future contracts get settled in a month or 3 months of time. So the formula, if fetched with the currency details, like the currency if is 83, so 83 plus the risk free rate of INR, which is 7% minus the risk free rate of the USD, which is 5%. So 7% minus 5% times the period, here in this case the contract is expiring in months, so it wouldn't be any multiple there. But if it was more than a year, say 2 years or 3 years, then it would be 2. So spot price here is 83, and the 7% minus 5% is 2%. 2% of the 2 is around 0.04. So 83.04 is the future USD of the future price of the USD. And this gives the currency detail. Now now the other computation that goes into calculations are the Black-Scholes formula, which helps calculate the premium, and which calculates option pricing. So like said, there are various kinds of derivatives. The major four categories of derivatives are future forwards, the options, and swap. Swap is like whatever transaction has taken place on the first day would be reversed on the settlement date. That is the simple definition of the swap. Whereas when it comes to the forward versus the futures, both have the similarity, both have almost the same criteria. That is, in both forward and futures, the price is determined for the future date, and for the future dates and the fixed price. And as most of the futures deals with commodity, it is in terms of lots. So that lot into the price would be the future contract price. Further, in case of currency, like the units are usually the USD would have 1,000 units. GBP would have GBP INR combination is one GBP INR currency is equal to 1,000 units, and similarly the EUR INR is also equivalent of 1,000 units. The JPY is equivalent, JPY INR pair or the derivative contract is equivalent of 1 lakh unit. So hence here when futures if futures versus forward is done, like said, futures and forwards are almost same. It's just the exchange on which both are traded are different. Futures trade on an exchange, and the difference between an exchange and forward for that matter trades on OTC, that is over the counter. The difference between the exchange and over the counter is specific, and it is private, whereas the exchange is matched. The orders are matched, and it is mostly like a contract. It is done in a agreement format. So futures and forwards are almost same. Swaps are the initial transaction. For example, the INR, if it is sent, the USD is settled in the real time settlement in the currency takes place. But on the exercise date, the same currency same transactions is reversed. That is, the USD which was sent is reversed, and the INR is given or paid to towards the quoted currency. So the nature of derivative currency contract based on the pairing of paired currency drives the swap, drives the values, and it drives the exchange on which it is traded. Now coming to the options, like we were talking about the Black-Scholes formula, which is log of S by X plus S square by 2 plus R times T, this whole multiplied by T divided by S to the power S to the multiple of root of T, where T stands for time, S stands for standard deviation, the small s, R stands for the risk-free rate. The capital S, log of S by X, is the spot price, and X is the strike price. So this is ND1. ND2 is ND1 minus exponential to the raised to the power minus RT. to arrive at the option pricing, it's SND1 minus XND2 into times e to the power minus RT. So this is this gives the option pricing. Now like to arrive at the call, obviously the call is going to be buy, and it is going to be at the spot price. So there the formula, the Black-Scholes formulas need to be like either added up or subtracted, but it has to be revisited. This is not complete as of now, but the Black-Scholes formula works like this. Further, in the money call, out of money call, and as at money calls, or calls or puts, is further explored. This is in line to the in line to the trade related to trade related to S, where that straddle options, spread options and all, but for the long call, long price, that is long payoff buyer, or this one. So whenever there is a option to purchase, and option to purchase at a certain strike in the future date, it is the strike is say 100, and the spot is 101. Since the contract is to call, so it is the strike, the contract is exercised, and the contract is exercised through the purchase of the USD INR at rupees 100, and since the spot is 101, it is sold off at 101 and gaining a rupee 1 of profit. So in profit call, whenever there is an optimistic side for the paired currency for the underlying asset, the derivative that is used, or the hedging instrument that is used, is the call option. And where there is a bearish side of the paired asset, that is the USD INR is expected to depreciate against the INR, then in that case the short future, the short futures payoff is considered. So that usually the chart is like on the x-axis, all the prices of the asset, that is USD INR, is laid out, and on the y-axis the profit margins are laid out. Now for a buy, it's going to start with a loss, that is the loss point would be from the minus of y-axis, and taken towards the upward of the y-axis, and to the right side of the x-axis. Okay, so it's upward straight line, and when it's the short futures payoff, that is the trader is of the opinion that there is going to be a bearish side of the underlying asset, that is the USD INR is going to depreciate. Then it is like the strike price would be 100 and strike price would be 100, whereas the currency might be trading at say 99. So already a loss of but it's a short, so it's I mean it's a loss of one no, it's a gain of 1, as the spot price is 99 and the contract was for 100. So he by selling the underlying asset at 100, the profit of 1 rupee is made. And the graph for generally the graph of a short futures payoff is downwards, that is on the x-axis. Like any payoff graph, the prices are laid down, and on the y-axis the positive and the negative profits are updated, and the graph maintains the minus that is a inclined line, that is on day one, since the contract was to short the non performing underlying asset, that is USD INR, short it, sell it at 100, and the price is obviously like 99, so 99 or below that, so the profit would be on the top, and then slowly, since the margin would be reduced and it would further fall down, so the price would the graph would also be on the between starting from the positive side of the of the y-axis, and then leaning towards the y-axis, negative side of the y-axis.